The worst fear was that this would become a 2008 type financial crisis and the collapse of one bank will lead to this domino effect.
That was Joel Shen, a partner at Withers Worldwide. But US regulators intervened to assure depositors that they would get all their money back, calming fears of a contagion. In Singapore, the vast majority of tech firms remain unscathed. Some who banked with SVB were able to move funds out before the collapse. But the fallout could still lead to broader economic impacts. Startups and investors are now forced to rethink their compliance and risk controls. Here are some key lessons from the SVB crisis. Firms should monitor their exposure to banks that may not have properly managed the risks around rising interest rates. Another lesson: diversification is key. As we saw, it is unwise for companies to park all of their funds into one bank. Firms should also strike a balance between having good returns versus having safe deposits and assess if banks are overly aggressive. Firms should also factor in legal and compliance functions to gauge the risks and regulations of banks that they work with. It would be prudent to have a backup plan in case things go south. Now, as we've seen with SVB, the solvency of established banks cannot be taken for granted.